the faster the ADR, the tighter the stop moving average I use. So if a stock is like a, 7-8% daily mover, I'm going to be using the 10-day. But if it's a little bit slower, call it like an Uber, I'm using the 20-day. And then once a stock pulls back and then pops right back up, then I'm using that higher low as my trailing stop, right? So, it could even then break the 10-day if it's a faster mover. But as long as it's above that higher low that it pulled back on the daily, like let's say it pulled back, found support on the 10, popped back up, pulled back again, broke the 10, but now, the 20 has kind of caught up to that last higher low spot, then I'll use that last higher low spot. So it then becomes the 20. And then if the stock continues just trending higher, then, as soon as the 50 catches up and this thing continues to build higher lows, I'll use the 50. So I want to not widen my stop, but the stock will decide, what moving average I get to use through its own price action. But if it's a slower stock and I'm buying it as it's incredibly tight, then I'm using, sometimes the 50 SMA right off the bat. So like something like Tesla, I believe that, it could have very well bottomed in here. I'm not sure. But when I bought it going right through the 200, right in the back of mind, I know I want to use that 200 as my guide. Like, yes, if it gets extended, to 400, 420, something like that fairly quickly, I'll be using, that to peel some into strength. But I'll want to use the 200 on a great name like Tesla, right? I mean, if they start to hit robo-taxis and humanoids, and I've got a 292 average and this thing's at 400, 410, 415, 420, right? Why would I want to get rid of this thing? Right? I mean, I bought it right at the 200. By the time I go to get stopped out on the 200 again, it's going to be much higher. And I could potentially catch a really, really awesome move.